Tax loss harvesting. That's the topic for today. Selling an investment at a loss on purpose is generally a bad idea because the actual loss of value probably exceeds the tax benefit from selling at a loss. However, selling to generate a tax loss on purpose, then reinvesting, so you stay invested, can be a good idea. And that's what tax loss harvesting is all about. It's selling on purpose to generate a loss to write off against taxes, and then immediately reinvesting. So you stay in the market and benefit from appreciation as the market comes back. That's the idea. Let's give you an example. On January 1st, so January 1st, 22, we buy the S&P 500 and we put, let's say, $10,000. This is the S&P 500. This is going to be we'll use the Vanguard Classic Fund. And as of yesterday, that investment, because the market declined, would have gone to $8,653 because the market declined over that period. So the idea here with tax loss harvesting is that we would sell on purpose at a lower value, realizing a loss of $1,347. That's the loss. So that's how we realize the loss. But in order to not have a permanent loss, meaning we sell and we're out of the market, we either spend the money or keep it in cash, we want to reinvest right away so that as the market recovers, we also recover our value. The IRS has a rule called the wash sale rule. And what that means is you cannot reinvest in exactly the same investment within the next 30 days. But their definition of a similar acceptable investment is very gray. It is not crisp. It is not a sharp definition. So what we look to are, number one, the custodian. So wherever you have your account, that's Charles Schwab or TD Ameritrade or whoever that might be. You'll notice when you get your tax document in January or February and you see all your capital gains and losses, that they will disallow certain losses if they broke the wash sale rule. And the way they figure that out is that the ticker symbol, the actual symbol of the specific investment that you made initially. So in this case, the S&P 500 Vanguard Fund, I think the ticker is IVV. So according to the custodian, if you were to reinvest in that exact fund, that exact ticker symbol, it would disallow this loss from a tax perspective. And that would be reflected on the tax document they send you. But if you reinvest in anything other than that exact ticker symbol, it will not disallow that loss. So that's the first place to look. You could be a little bit more conservative and invest in something more substantially different if you'd like to. But again, it is a gray area. It's probably something to talk to your CPA about. But technically speaking, with a custodian, you could invest in a different S&P 500 fund, maybe managed by iShares or Fidelity or some other provider. You could also invest in something very similar to the S&P 500, maybe some other U.S. large cap index fund that is highly correlated to the S&P 500. There are plenty of those to pick from. So the idea is that if we were just to stay invested in the S&P 500 and it recovers, then in fact we don't lose any value at all. But because we sold and we're going to reinvest in something similar but a little bit different, we'll likely benefit almost the same as we would if we never sold at all. So the dotted line is whatever other investment we happen to buy that behaves a little bit differently, but largely much the same as the original investment. So if we're able to do that within the rules of the IRS, our sale generates a tax loss, but not a real financial loss because we stay invested, and as the market recovers, we benefit from that. That's what tax loss harvesting is all about. So the question now becomes, well, what is the value of that tax loss? Well, there's a couple of benefits to this. Number one, or potential benefits, you can write off, per the IRS, if you're married filing jointly, up to $3,000 in capital losses. This is called a capital loss. You can write off up to $3,000 per year against your earned income. So the income from your paycheck, your regular income, it's subject to federal income tax rates, which are generally higher than the capital gains rates. So if you're in the 25% bracket or something like that, you can write off $3,000 or up to $3,000 per year against your income. So if you're again in the 25% bracket and you're writing off $3,000, well, that's a pretty good dollar for dollar tax benefit. That's pretty easy math. If you happen to have a larger capital loss than the $3,000, you can offset against big gains in a particular year. So, for example, you sold a business or you sold a piece of real estate that generated a substantial capital gain. What you could do is realize some losses on some investment assets and offset those large gains. So maybe you sold a rental property and it generated a $50,000 capital gain. Well, you could use some of these losses you generated from tax loss harvesting to offset that gain in that year. So if you had a particular year with some large capital gains, that would be a productive use of this strategy. Another potential benefit is called loss carryover. So if your loss allowed for the full $3,000 against your income, plus any other big gains you might have had that year, if you've done all of that, what you get to do is actually roll over the additional losses to future years, so that when you have some gains in the future, you can take advantage of 1 and 2 with whatever the balance is that you didn't use. And the fourth potential benefit is just plain old tax deferral, which means if we don't have to pay the taxes now, we'd rather not. So just the concept of pushing taxes out into the future means we keep more funds in our accounts that can invest and compound over time. So that's usually just financially, economically a benefit. That's part of the reason we use 401ks and Roth IRAs and any other type of tax-deferred type of retirement account. I should mention that this only applies for non-retirement brokerage accounts, because non-retirement brokerage accounts, often an individual account or a joint account, are taxed as you go. They generate the 1099 that you receive each year to file with your taxes. Whereas your IRA, 401k, Roth IRA, none of this really matters in those accounts because you are not taxed as you go. You're only taxed, if you're taxed at all, when you take the money out at the end. So the capital gains and capital losses only apply to investments that you have in a non-retirement brokerage account. So once again, to recap, tax loss harvesting means selling an investment on purpose to generate a tax loss and then reinvesting in something similar but substantially enough different per the IRS so that you can participate in the growth of similar assets that probably behave similarly, so that you don't have a real economic loss, or it mitigates that economic loss from the strategy. And then you can take that capital loss and use it to reduce your income taxes potentially this year, to reduce other capital gains taxes in that year where you execute the strategy, And if you've done as much of that as you can roll it over to use in future years. And the general benefit of tax deferral is usually helpful over the long haul. That is tax loss harvesting.